Welcome, guys. I'm back. Okay, so we're gonna have a little talk here, real quick, about how to become a profitable trader in 2025, the easy way. Okay. Um, but before I do say that, I did have a live class session, but it is not letting me post it in the Discord, so I am sorry for that. I'm working on it. I'm working on a way to get it in there, but I don't think it's gonna happen due to the fact that it's too big to put in Discord. So I'm going to be posting it on YouTube as raw footage. It's about 2 hours and 30 minutes. Something simple for you guys to watch. But yeah, so that being said, sorry for the inconvenience for the students that are in the Discord. And let's get to today's session, right? So becoming a profitable. So becoming a profitable trader is easy but not as easy as you would want it to be. It could be very easy as long as you are very dedicated. You're very motivated to actually progress in this lifestyle, because this is not just a career, it is a lifestyle. The way that you think about things will be different after learning how to trade the stock market and after learning, how the market loves to manipulate things. Your mindset will change overall, and just in general, with discipline, uh, guardrails to your everyday life, as I would like to say. Okay. This is not for slackers. This will not work. We will not work if you're slacking. Okay. Me and you, I will not be your teacher if you're a slacker. Okay. I want people who are dedicated, who are motivated to actually learn this, because this isn't something for the average person. This is for the person who really wants to get out of the rat race, who really wants to progress their life and become financially free, hopefully. Now, with that being said, I am not your financial advisor. I do not promise any of the things that are to come, but with my experiences, I'm just showing you that it's possible. Okay, it's a possibility. All right, that's all I'm saying. Okay, so understand what it is to become a profitable trader. Okay, and what it means to become a trader. Okay, it's not a get rich quick scheme, as a lot of people may make it look like. I don't know if you've seen a bunch of gurus posting, oh, first day of trading with a $500 account or $1,000 account, I made $10,000 or $5,000. Guys, these are people who have been in the markets for years. Okay, these are people who have more back testing knowledge than you have ever experienced in your entire life looking at a chart. Okay. Um, so obviously they might see a lot more things than what you see starting out. They have been doing this for 5 years, 2 years, 7 years, however the case is. They have been doing this for a while. This is what they live by. So obviously they're going to see a lot more because they know a lot more than what you are going to when you first start out. So always keep that in mind. This is not a get rich quick scheme. It can become gambling if you let it. And what I mean by that is if you don't have the proper guidelines in place, guys, it'll hurt your account. You will go on tilt very fast, and you will lose a lot of money. So please, 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 when you create your strategy, or if you decide to take and develop my strategy under your own wing, please do so with caution. There's going to be days within the market that you lose. Okay, there might be even out of the year, there might be a week that you lose a straight week that you lose. Now, I'm not saying you need to lose $1,000 a day to lose. You could have a max daily loss of $200. If you lose $200, you're done for the day. Okay, you're done. You're tapped out. But I'm not saying that my strategy is 100% profitable. Okay, there's going to be days that you lose. My goal is to make sure that the days that you lose do not outweigh the days that you win. That's all I'm trying to do. If your losses are outweighing your wins, you got to tweak your strategy a little bit. Like you're risking too much for too little at that point. You feel me? Like, so all right. Trading is a risk within itself. You have been warned. I'm not your financial advisor, so I cannot promise you that you'll become profitable doing this. I can just show you my past in trading and my experiences in trading that have made me profitable. All right. Also keep that in mind. All right. So my goal is to basically make you, not make you, kind of help you leave your 5 to 9 job or everyday job, unless you're content with that. Some people love working either at Subways or in their clinic's office as a front desk representative or whatever the case may be. You might even be a doctor. Okay. You might sell houses. You might be a salesman. Okay. Like some people like their actual job, believe it or not. Me, I did not. Okay. I worked as a welder. I worked as a Domino's employee. I worked as a Boyer's employee. I worked at Walmart. Bro, I worked a lot of different jobs testing the field, seeing what I would really like to do, whether it's a millwright work or standardized warehouse work, like I tested the fields. Pause. I tested it to see how like what I would like to do with my life. When I found out about trading stocks, I was very skeptical about it because I didn't know there was actual strategies that I could use to become profitable. I thought immediately that it was fake and that it's a way for people to trick other people into getting money from them for buying courses or from having them buy and share their meme coins or whatever the case is. I can guarantee you this: if you trade meme coins, you are going to lose a lot of money. I do not trade meme coins, okay? I don't even trade crypto. I trade US 30, which is a futures market, and I trade NASDAQ and ES, which are also futures markets. The reason why I do that is because it's not as much to get into. During intraday, it's not as much. You could buy one stock of NASDAQ micros for like $120 and upscale your account in one day to possibly even $1,000. I've done it before. I'll post that video because it's an upcoming video that I have for you guys. But I'll show you how to do that just by using my strategy. You could use my strategy. You could go on YouTube, learn somebody else's strategy. I don't care. I just want to teach you the fundamentals to become profitable. Okay, so let's talk about the first thing. This is the first thing you always need to know about: candlesticks. Okay. Now, there's two type of candlesticks. There is a red candlestick and a green candlestick. Okay. A red candlestick is known as a bearish candlestick. It is when there is sellers in the market that are trying to push the price down. Okay. Green candlesticks is when there's buyers in the market trying to push the price up. Okay. And the way I love to think about it is when you get hit by a bull, where are you going? You're flying up, right? Exactly. Bull's going to push you and throw you in the air. As if you were to get attacked by a bear, you would be clawed to the ground, right? That's why bearish and bullish candlesticks are known as red and green candlesticks. Bullish being green, bearish being red. Okay, so keep that in mind. This slideshow will also be available for you guys via Discord if you want to go through it as a viewer and just go through all these notes. If you can't write anything down right now, that's perfectly fine. That's 100% understandable. Okay. Um, so another way to describe them is a bullish candle is made when volume of the market is taken over by buy orders, bidding on the market to go up. Bearish candles are made when the volume of the market is taken over by selling orders, bidding on the market to go down. All right. Um, it's kind of like a tug of war if you want to think about it. Best way I can explain it, kind of. Price is doing one of two things: going up and down. I lied. Price is doing one of three things: going up, going down, or shimmying in the middle. Okay. But at the end of the day, it's either going to continue going up or continue going down. Okay. I am what's called a breakout trader. I love to trade out breakout trends. I love to trade break of structures and things of that sort, fair value gaps, all those things. I mix a lot of different trading concepts into one to create almost not a flawless strategy, but pretty damn close to it. Okay. So keep in mind, I'm making about $1,000 a day. You do not need to be making 50 grand a month. You don't even need to be making 10 grand a month. Okay. You can make 5 grand a month and be perfectly fine. If that's what you're comfortable with, you can be perfectly fine with that. My goal is to make at least 25,000 a month. That's it. 25,000. That's my goal. Once I get to that point, it's all fireworks from there because I'm not stopping. I'm gonna keep going. All right. I don't know what I have in my beard, but it ain't coming out. Anyways, so again, this is what what a bullish candle would typically look like. I want to explain some things in here so that it's not as confusing when I go later on down. Um, there is something called price action in the market. It is the current price of where the current price is. I don't know how else to explain it, but um, for a bullish candle, the current price would start at the bottom of the candle. It'll look like this. It'll be a small body or a big body, but this will be considered the open of the bullish candle. The open of the bullish candle again is where the price action starts at for that candle. Okay? The current price action starts at for that candle. The lowest price is where the wick completely taps out at the bottom, and the highest price is where the wick taps out at the top. These wicks are important, um, but not as important as the open and close. Okay, it's just to kind of show you where price has moved within those time. So if this was a 1 minute candle, everything that happened within these wicks and this body is what happened within 1 minute. If this is a 5 minute candle, everything that happened within this market or this candlestick is within 5 minutes. Okay. Pretty self explanatory. All right. I have it listed up here too. Movement within the candle is the wick. Okay. Um, and the close is obviously the top of the candle. Now, the only difference between a bullish candle and a bearish candle is the open and close are flipped. Okay, so for a bullish candle, it is the open is the bottom and the close is the top of the little box that closes it out. All right. The next one is a bearish. So the only difference here, the wick is still the same. It's still the time that, price decided to move in, and make those wicks. All right. The only difference is the open and close is different. The open is now the top of the candle. This is where the current price would start at, and the bottom is where the current price would close at. Okay? So keep that in mind. They're just complete opposites of each other in that aspect of opening and closing. Okay? Pretty simple. All right. I'm watching. It's simple. Don't overcomplicate it. Okay, so we're going to go on to my strategy and how it comes to play. Okay, but in order to explain that to you, I kind of need to explain the concepts of each and everything that I use in my strategy. So bear with me, please. Okay, consolidation. Obviously, consolidation, I'm sure you all have heard it in high school, middle school, or some type of year in your school. Okay, you've learned this. And if you haven't, well, man, I don't know what to tell you. But it's basically, like I said earlier, a tug of war of bullish and bearish candles. The price hits a zone where bulls or buyers in the market want to push the market up, but there's also bears or sellers that want to push the market down. So it's kind of just bouncing up and down in a tiny little zone. Or it could be considered a demand zone or support zone or resistance zone. There's a lot of different things that people call it, but I just call it consolidation zone just because it's simple. I'm not trying to confuse you guys calling it demand zone, support resistance zones, whatever the case may be. Like, I don't want to do all that for you guys. So I just want to keep it simple, and that's how I keep it simple. Cool, cool. Anyways, uh consolidations normally happen at the top or bottom or middle of a trend. So if the market's pushing up, it may have a consolidation before deciding whether it wants to keep pushing up or reverse and go back down. If it happens in the middle of a trend, same thing. It's debating what way it wants to go. If it happens at the bottom, same thing. It wants to decide which way it wants to continue, whether it wants to keep going down or go up or whatever the hell it wants to do. Which taps back into the first thing I said. The market's only going to do three things: go up, down, or shimmy, going sideways. Um, okay, consolidation. Simple, cool. I'm glad you understand it. I hope you understand it. All right. Now, there's something called false breakouts. This is not something that I always typically look for. It's kind of an indication that the market is starting to gain volume, meaning it's starting to become more volatile, meaning it's starting to gain speed as of going up and down. Okay. So false breakout, something that I do look for, but not all the time. Um, it's basically when you have a consolidation zone where it's listed here with these black lines, and there's little breakouts like this that happen, and then it pushes back into the zone quickly, rejecting completely against that position. Normally, that just means there's starting to show weakness in that specific area. And same thing down here. It happened down here. It's starting to show weakness in this area, meaning buyers and sellers are starting to like actually push against each other. Like they're starting to have a heavy influence on the market. Okay, so it's not something that's make it or break it moment for a trade. That's all I'm saying. It's just something that I like to look out for just in case. So support and resistance zones. Now, this is something that is kind of a make it or break it moment for a trade. It's also a really big indicator that it's going to show you where the market's going to go. Support and resistance zones are normally created around consolidation or after a fair value gap. I'll talk about the fair value gap later, but right now we need to focus on how it's affected by the consolidation zone. Now, as you can see here, right, the market was previously pushing up, right? It kept pushing up, but it bounced right here. Normally, this first pullback, that's what it's called, when the market has a little pullback, whether it's going up and pulls down a little bit, then continues going up, or whether it goes down and it pulls up a little bit, then continues going down. That's considered a pullback, okay? Um, I'll talk more about that later as well, so you guys get the concept of that. So right now, the market is pushing up. It hits this high of the day, and then it pulls back, right? But it doesn't continue to go all the way down. It has a little pullback. So normally this would be a regular zone of a lower high, okay? It'll start here. This will be considered your higher high. This will be considered your lower high, okay? Now, if this were to continue, that would still be considered your lower high as long as it did not pass your previous level of support. Okay, but I'm getting ahead of myself. Let me slow down. So the fact that it did not pass the zone, it's just kind of the start of the consolidation zone. Keep in mind, consolidation zone is just a little spot in the market where it bounces sideways. Okay, so as you can see, it tended to trend back up, and then it created this lower high. Keep that in mind, lower high, okay, before pushing back down and creating a lower high again. So now it's like, okay, it's just bouncing, okay? So now we see it continue to go up and hit the same high, but it didn't pass. It didn't pass the previous high right here, okay? So as the market trails back down, it hits the same low. Now that created a valid consolidation zone, okay? It's not passing previous highs and it's not passing previous lower highs, okay? It's stuck, all right? Now we need what's called a BOS, break of structure, out of one of these zones to find out whether we should implement our strategy into this trade or not, right? And remember how I told you a consolidation zone goes sideways? That's exactly what this is doing. It's going sideways. It created our consolidation zone. So this is rule number 3, tapping back into rule number 1. Now, the thing I love about my strategy is the fact that it renews itself. Every rule that I have in it always traces back to rule 1. So it allows you to see multiple opportunities within the market. So if you miss a trade, do not cry over it. There's always going to be another trade that you can take, possibly that day, or maybe the next day. The market's not going anywhere, guys. There's days that I've missed $10,000 moves, $20,000 moves, and I was upset about it, but I didn't get FOMO and just jumped in. Like, that's stupid, okay? You're gonna miss days like that. You're gonna miss trades, and sometimes you might even be thankful that you miss trades like that, okay? Um, but let's continue. All right, so this is now a resistance zone. A resistance zone is where sellers are sitting, okay? That is where a bunch of sell orders meaning bears are sitting at. They're just waiting to attack. Okay. The bottom here, where it bottomed out like 3 times, is called a support zone. Okay. A support zone is made when a bunch of buyers or a bunch of bulls are sitting at to keep pushing the market up. Okay. Now, if either of these zones get broken, that is a heavy indicator that the market is going to continue that way because there wasn't enough support or resistance at that zone to keep it in that consolidation period. All right. Now, a popular trade is once you have a breakout to the upside. Let's say this is resistance. Bulls are pushing the market up, up, up. It taps out here, it pulls back. A lot of people would necessarily take the trade right here, okay, and then they'll take this little pull up to the upside. Once they realize it's not passing this zone, they would probably put their stop loss somewhere under here and get out of the trade, okay, just to cap out at their profits, I'd say. But it ended up bouncing back down, touching another previous resistance level, creating a new support level. So that kind of tracks our consolidation level from down here and pulls it up here. As you see, our resistance level is still the top. Our resistance level is still the top on this side as well. Same thing. Our support is still on the bottom down here, but over here, it's still on the bottom down here. Okay. They just literally shift. That's all they do. Um, that being said, that's a simple demonstration of support and resistance. It is a really big part in my trading strategy. It helps me get decent entries. At the end of this, at the end of me talking about this, I will show you a live trade or how it would play out. Okay. All right. If you want to read all this, you can, but I ain't got time for it, so I ain't reading all of it. All right. Again, this will be available in the Discord, only in the Discord. So join the Discord if you want to go over these slideshows and, go about it yourself. Break of structure, my favorite. I love break of structures because normally when break of structures happen, there is a big move coming, okay, or a big move prepping itself to happen. Now, this is normally SMC trading or ICT trading. Um, I'm not considered one of those because I don't even know what the hell they mean. All right, I'm gonna keep it a buck with you. I don't know. Anyways, break of structure. All I know is when break of structures happen, it's breaking out of a consolidation zone past a support and resistance zone heavily, making a fair value gap. Okay, it's going to make a big wick, whether it's a really big wick of green or a really big wick of red. Okay, so normally that's what happens when a break of structure happens. It breaks with volatility. It breaks going really fast to the downside or upside. It's as simple as I can make it. Over here, I can show you. You got a bullish trade, right? It's going up. It makes a higher high, then makes a lower high, but breaks the previous higher high, creating new higher highs. Okay, and it just keeps going until it has another pullback, and that next pullback is now your new lower high. All right, this down here would be considered your lower low at that point. All right. I'll make another class specifically talking about each and every individual thing here. This is just to go over everything that I use. It's like a rough draft of the deep rabbit hole. Okay. So I'm not going to spend too much time talking about it. I just want to tell you about it. All right. And then obviously it's making new higher highs and continues to do so. Okay. That's break of structure. When it breaks structure, when it breaks out of that support and resistance zone, which is also considered the consolidation zone because it's made up of support and resistance levels, it normally breaks and it goes crazy. Okay. Same thing going down. So going down in a bearish trend, this is considered a lower low. Okay. This first pull down. Okay. This is considered a lower high. Once it breaks that previous lower low, this is now your new lower low. Again, when it pulls back, this is now your new lower high. Okay, it's fairly simple. Then it continues to break and make new lower lows. Okay, that's how the trends work. They make For bulls, they make higher highs, higher lows, higher highs, higher lows, higher highs. Okay. For bears, higher, sorry, lower lows, lower highs, lower lows, lower highs, lower lows. Simple, right? It better be. I can't explain it any simpler, guys. Come on, work with me here. Jeez. Anyways, fair value gaps. Another part that I love. Okay. When you see a break of structure, this is what I mean it does. It makes a fair value gap breaking out of that structure. Either a really big candlestick that's green or a really big candlestick that's red. Now, with bullish gaps, yes, we call them gaps. Normally, I'll talk about that too. I'm explaining it too much to you guys. You ain't even in the Discord, and for the people who are in the Discord, you'll learn about it later on. All right. Anyways, bullish fair value gaps are made by taking the previous wick of the previous candle, the height of it, and making a line there, and taking the wick right after that big move, and going off of the bottom wick of that candle. That's for bullish trades only. Okay. This is going to create what's called a fair value gap or a fair value gap zone. Okay. Usually, when price will keep going up, tap back into this zone, which is down here, and then it'll continue to go up even higher. If price decides it wants to tap into this zone and keep going down, that is now known as a inverse fair value gap. The reason I love fair value gaps is because there's only two. Okay. There's a standard fair value gap, and then there's a inverse fair value gap. There's only two of them. There's not four. There's not six different versions. It's only two. Okay, so it works really well with the concept. All right, the concept being simplistic. Get with the program, God. Anyways, uh, the difference is with a bullish fair value gap and a bearish one is a bearish fair value gap is made when the by the previous candle, right? We're going off of the bottom of it instead of the top, where over here it's showing the top. We're going with the bottom of it. Okay. That's your first line. That's where you would put your first zone. Okay. Then we would go to the next candlestick over and go to the top of it, not the bottom, the top. And that would create your fair value gap for a bearish trade. Now, normally price would come down and tap back up and tap into the zone to continue going down. Again, if price is going down, taps into this zone, does not respect it, and continues to go up, that is now a inverse fair value gap. Okay, that means that gap has been filled. There is no longer the necessary need to look for bearish trades. Okay, now you should change your bias to bullish. Same thing here. If the bullish trade becomes inverse, or the bullish fair value gap becomes inversed, you should not look for any more bullish trends. You should look for bearish, like sell orders. Okay, simple. If you want to read this, be my guest. Okay, just a simplistic version of it. All right, using my words. Next, liquidity sweeps. Now, these are important, but they're not as important as you would think. Normally, this is just after the break of structure, it will sweep in your direction or go completely against your direction. Okay, that's that. So you're either going to get stopped out or you're going to continue with the trend. Okay, it's normally for a bullish sweep. It's basically this zone right here is your consolidation zone, right? Then it breaks out of the zone, which is a break of structure, makes a higher high, right? Comes back, makes a lower high, taps back into this zone, right? And then it continues to make higher high. That's a sweep to the upside. That's a bullish liquidity sweep to the upside. A bearish liquidity sweep is when you have a consolidation zone and you have a gap under here. Same thing over here. You have a gap over here, but for bull or bearish, you have a consolidation zone up here. It breaks structure, creates a lower low, then creates a higher high, tapping back into this zone, and then continues to make a lower low. That is sweeping to the downside. That is a liquidity sweep to the downside, a bearish liquidity sweep. Okay. It's the simplest way I can explain it to you. You can look into it more in depth. This is another SMC or ICT trader style. It's just something I love to add into my end of the trade. Like at this point, I should already be in profit. You should already be in profit. This is just going to basically maximize your profits. Okay. So I would then start trailing my stop loss behind each big candlestick that it makes, just to cap out at the most that I can, you know. All right. Any questions? I don't care. Join the Discord if you want your questions answered. Anyways, so this is just to show you what liquidity sweeps may look like in the market. All liquidity sweeps are doing is they're filling gaps that have been made in the market. And what I mean by gaps are zones like this. This is a gap, right? This is a gap. 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 That's all it is. It's just filling the gaps. So after your break of structure with your liquidity sweep to the upside or downside, it's making a gap that now has to be filled. And what happens when a market goes up? It has to come down. What happens when a market goes down? It has to come up. Eventually, it's just going to keep doing. That's what I mean. The market's going three ways: sideways, up, or down. That's it. Simple. Okay. And I'll show you why this is not gambling, guys. So stop calling me a gambler. Stop calling me crazy. I'm not crazy. I'm educated in a trading strategy. Anyways, right here is buy side liquidity, sell side liquidity. That's something more in depth that you really don't need to know. All you need to know is that this is a selling liquidity sweep. The market is moving heavily down here. It's just constantly pushing down. This is a buy side liquidity where market is obviously buying it up at rapid speed. Same thing here, sell side liquidity. And all it's doing is filling the previous gap. So you see how this is a bunch of buying pressure, right? This is a whole bunch of selling pressure. Okay. Then what happens after the market pushes it back down, that selling pressure? A whole bunch of buying pressure. And what happens after a whole bunch of buying pressure comes into play? A whole bunch of selling pressure. That's all it is a whole bunch of pressure from either or side, buying or selling. Same thing. A whole bunch of buying pressure, then it's filled out with a whole bunch of selling pressure. This in itself can create a consolidation zone. It'll just be a really big consolidation zone. But this up here where it says buy side liquidity, you can just name that as your resistance zone where there's a bunch of sellers sitting at. Because as you see, the market touched up here and sold crazy. Okay. And down here, this is your support level. This is where buyers are sitting at. As you can see, when market touched down here, people bought into the market, raising it up, bringing it up. Okay. Same thing over here. They brought it up. Same thing over here. They brought it up. Simple. So, developing guardrail strategies, okay? You now know my entire strategy from start to finish. Consolidation zones as 1, false breakouts as 2, support and resistance zone as 3, break of structure as 4, fair value gap as 5, and liquidity sweeps as 6. Okay? 6 steps. That's it. Okay? 6 steps is all you need, and you'll be chilling like a villain. All right? Now, what I mean by developing guardrails to your strategy, this is what helps you turn this from a not gambling perspective to an actual trading strategy. Okay. Uh, Daily bias. This is step one of 3. Okay. Step 1 of 3. All right. Daily bias. Decide what type of trader you want to be for the day or the week. Once decided, find levels of support and resistance zones to decide if the trend you decided to go with is a valid trend. Okay. And this one, which is step 2, trend understanding. Once you've created a valid bias of the market, you can start looking for entry points to take on your trading idea or your ideal trade, whatever you want to think. Now, let me show you what that looks like, okay? So here we have a live market. Currently, you can see we are on the day chart. This is for the day. Obviously, down here, it bottoms out. That's how much it's moved within this day so far. Up here is a tiny wick, is how much it moved within that day. All right. So I like to write down what each thing is, like what each time frame is, whether it's bullish or bearish. So currently it's bearish. All right. Crap. Oh my God, I put 2 B's. Guys, I went to school, I promise. Um, I'm over here reading it like it didn't actually say bearish. I thought I was really like actually dumb. Okay. So That's number one. That's your day. Then I'll go down to the 1 hour. Okay, the 1 hour seems to still be very bearish. As you see, it's making lower lows, creating lower highs, then breaking previous resistance zones to go lower low, creating lower highs, breaking zones again to make lower lows and lower lows. So as you can see in this little zone right here, it started to create a consolidation zone. So that is worrisome. That's showing that market's starting to lose its selling pressure. The market's starting to make imbalances. Okay. So now showing buyers or bulls are starting to step into the market on this trade. But so far it is still bearish. All right. Huge wick to the upside, but it's still bearish. Okay. So that would be what, the 1 hour, 1 hour, which is still bearish. All right. So now we got two things that are showing bearish. My bias for the day is so far bearish. Let's go to the 30 minutes. 30 minutes is also bearish, right? So let's make that. 30 minutes is bearish. All right. Let's go to the 10 minute. The 10 minute is, as you go down in time, it becomes more like realistic on what you're seeing and what the market is doing. Okay. So, yes, it is still bearish. But again, that zone that I talked about earlier, it started to move sideways, which is showing there's starting to show buyers. It still broke lower lows and it's still technically making lower lows. But right here is where I would have gotten out of the trade at the top here. If I went in from all the way up here, I would have got out probably at the top here because that is showing heavy like buying pressure at the bottom there. So it might be getting ready to bottom out. But this is now in the 10 minutes. Okay. This is now another bearish symbol with a little bit of resistance. Okay. So bearish. And then just, you could go to the 5 minute, 3 minute one, but I like to just skip from the 10 minute to the 1 minute and see what's actually happening within the 1 minute. 1 minute, it is moving sideways like crazy here. Okay. And then it broke lower lows, came back up into our zone, which is what I said. Let me show you what it would look like. You make your support and resistance zone here. That's your consolidation zone. It came out of our consolidation zone. It tapped back into our consolidation zone. You would have taken your trade somewhere here or at the end of here, then took that little trade down and got out. Okay. So that's just to show you what it would look like quickly. But still, it's still bearish, still considered bearish. Now, if this does not pass this lower low here, like if this little circle, I'm sorry, just put it over here. If this little area here does not pass lower lows and does not pass this zone over here, my guy, at that point, you need to change your bias because it is no longer going to be a bearish trade or bearish trend. Okay. So that's just to show you, and just to have it in writing. You guys are so needy. There it is. So you got a day bearish, hour bearish, 30-minute bearish, 10-minute bearish, 1 minute bearish. The entire thing's bearish. Okay. So my bias for that day is bearish. I would be a bearish trader, but since I'm what's considered a hybrid trader, I love to trade bearish and bullish trends. I see a little bit more than what you guys see. So if I sound confused or if I make it sound confusing, it's not, I promise. Okay. Um, that being said, daily bias is bearish, okay? And I've marked out support and resistance zones in my head. I've marked them out, okay? Understand for the key points. Now let's take our strategy, okay? Let's take our strategy over here. So now you have a full day of bearish, okay? It is at the, literally, it's been trailing down forever. So let's just go off of what we see, okay? What I like to do is I like to mark out a consolidation zone. So what I would do is I would take a zone from all the way over here. This is in the 1 minute time frame. Okay. We'll take a zone from all the way over here and bring it all the way over here. I already know what's been happening this entire time. And the reason for that being is this over here is our low, our previous lower low before it breaks all the way over here. It's been consolidating. This is our higher high or higher low. Sorry, it's a bearish trade. So this is considered our higher low. This is considered our new lower low. These are where it has to pass to continue a trend. Okay. So this creates our consolidation zone. So now we have to wait for a break of structure, a break of, our support or resistance line that's heavy. Now, as we zoom in over here, it did break here and then it tapped back into our zone. That would be considered a false breakout. But some people might not consider it a false breakout and take that short here. Just take a little short play right here to the downside. All right, they might be lucky enough to cap out back here, but if not, they're going to get stopped out. Okay. So now we have our consolidation zone. Let me mark that out for you guys so you can see, right? I put it as con because I don't like typing out consolidation. It's a lot of work. Okay, so now we have a consolidation zone. We have what's considered to be a false breakout. It taps back into our zone and it takes a little bit of a lower low. That created a new lower low, but then it consolidated for a little bit, tapping back into our zone, which now makes that a imbalance in the market. Okay. Some people may call it a small liquidity sweep to the downside, then another liquidity sweep back to the upside. But as you can see, it tapped the bottom of our zone again, of our consolidation zone. It went sideways once more, and then it tapped a little bit back up. And it's starting to look like it's consolidating once again. All right. Then it breaks for another time to go lower low. Now, to kind of get what the market's actually doing, I like to traverse between the 1 minute, 3 minute, and 5 minute. Sometimes even go up to the 15 minute just to see what the overall thing is doing. That's it. I'm going to edge it. If you want to watch the rest of the video, you got to come to the Discord and watch. If that did interest you, though, join the Discord. Don't know what to say. Join the Discord. Anyways. Okay, so we have all of our zones that, all of our strategy requirements were hit to take our trades. Well, I mean, you wouldn't know because you can't see the video because you're not in the Discord. Sorry. Anyways. So as you can see, these are our strategy guidelines. I highly recommend you make your own or you follow this one. Have something that kind of keeps you in that zone. Okay. Now, continuing, the market is not your friend. It does not like you. It does not care what you do with Teresa last Saturday. It does not care what you do with Benjamin Franklin on the 3rd. It doesn't give a shit. Okay. It is not your friend. Okay. Now, I do want you guys to decide which style of trader you are going to be. You can either be a bullish trader or you could be a bearish trader. If you're a beginner, if you know what you're doing, I don't know why you're in these classes, but if you know what you're doing, you can be a hybrid trader, which is down here. Trade both styles of stocks, bullish and bearish trades or trends. A bullish trader, just to show you guys what it is, bullish traders are known to place trades in the market as it rises, awaiting for pullbacks to the downside for better terms to buy into the market and ride it to higher prices. That is a bullish trader. Bearish traders are known to place trades in the market as it spirals down, awaiting pullbacks towards the upside for better terms to short the market on. Okay? Simplistic versions of bull and bears. It's not that hard. If you don't understand, then damn, that's tough. Last thing that I want to talk to you guys about is your win rate and loss rate. Okay. Well, your risk to reward ratio. Okay. Don't get greedy. Don't get greedy. If you're up in profit, don't give that back. I've seen people who have stuck to their strategy when they're up $1,000, their take profits at $1,200, and they let the market come all the way back down from $1,000 in profit and stop them out at negative $250 or $300. You're crazy. Sometimes they'll even bring it to break even and be stopped out at break even. Bro, you're crazy. Once I'm past $500, I'm trailing my stop. I don't care if I miss the $1,000 limit. Some traders, when they hear that, they'll be like, oh, well, that's just because you don't trust your strategy. No, I like money. I'm not going to give said money away. Okay? I don't care if it's me being greedy. I don't care if you think it's me not following my strategy, but really my strategy is scalping. I'm there to make little bits of money that add up over time. If I can make one trade and make $1,000 off of that trade, beautiful. It could be a quick scalp on the 1 minute that I do that. That's what I've been doing. That's how I've been making $1,000, just taking quick scalps. My take profit normally for a 1 minute time frame, I'll put it at $3,000 because I know it can spike up that high in that time frame. But I'm really aiming for like $450. That's it. Because $450 a day for a whole week, that's like you're making $40 an hour each day for an 8-hour shift. Guys, that's above that's above like minimum average of, your wages. Like, come on now. You don't need to make $1,000 a day to become financially free. You can make $500 a day and still end the week with $2,500. Is that really that bad? When you're only traded for probably like an hour throughout the entire week, it's not bad. And you get the rest of your day off to play video games, go to the beach, have fun. But in summary, don't get greedy. In the trading community, there is something called risk to reward ratio. It's just a fancy way of saying how much you're willing to risk versus how much you're willing to gain. Okay. So for example, if you wanted to make a proper risk to reward ratio, you would divide 3 against whatever number it is you want to make. So let's say you want to make $500 in one trade, but not risk too much. You would then divide 500 by 3, which would give you 165, and I rounded down for that. So don't come at me for my math. But that basically would mean you would be risking $165 for $500. That is known as a 1-to-4 or 1-to-3 ratio. Okay. It says it over here too. Risk to reward factors. This is just how much you are willing to risk to gain a specified amount. Okay. For example, if you want to risk $100 to make $100, then that is known as a 1-to-1 R&R, risk to reward. Okay. You're willing to risk $100 to make $100. But if you wanted to risk $200 to make $100, then that would be a 2-to-1 R, which I do not ever recommend. Put that in caps. So you got it. Never do that. That is horrible. That is horrible, like risk. That's horrible money management. Like, now I know why you're always broke if you think that way. Come on now. All right, so you got the 1-to-1, $100 to $100. You got the 1-to-4, which is $150 for $450. 3-to-12, which you're risking $400 for $1,200, and 2-to-1, which is $200. You're risking for $100. As you can see, it's good, 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 bad. These are really good to go with. You never want to risk more than what you would make because that's just stupid. That's just dumb. That doesn't make any sense. Okay. So back to the beginning, guys. What type of trader do you want to be? Okay. Do you want to be a profitable one, or do you want to be one that's just gambling with their money? Anyways, again, thank you for attending today's class. If you watch this video from start to finish, you are obviously interested. Hit me up for the Discord or go on my Instagram to find the link to my Discord in my bio. Join up, come learn for completely free. It's no charge to you. I help you get a practice account so that you can practice trading with fake money, just to kind of see if you can actually do it, just to kind of break that it's like that icebreaker to break your I don't know how the saying goes. Sorry. It's an icebreaker. There we go. So if you want to learn how to do that and you want to just come in here to have fun and learn something that could potentially give you financial freedom, I don't know what you're doing. Hurry up, get in the Discord. I ain't got the time in the world. You ain't got the time in the world. So let's get this going. It's 2025. It's time to change up your lifestyle. It's time to change up how you make money. Thank you for attending. Goodbye.